Welcome to July. 6 months of the year are behind us and we're into the second half of the year. July also marks the start of the tax season. SARS will be opening tax filing season on the 7th of July, and as a taxpayer you have until the 23rd of October to file your tax return, unless you're a provisional taxpayer, in which case SARS allows you an extended period and you'll need to have filed by the 24th of January next year. Last year, SARS introduced a new process to the filing of tax returns called auto-assessment. This is aimed more at the less complicated taxpayers who maybe receive income only in the form of a salary or have very few or no deductions. This year, SARS will also be running out auto-assessments, but they've made a small change to the process. Last year, SARS would send you a notification saying that they had auto-assessed you and would give you 40 days to either accept or amend your tax return if you weren't happy with what they had calculated. This year you will have until the 23rd of October to make a revised submission if you're not happy with what SARS has calculated in terms of the refund due to you, and or they may have calculated that there is tax that you will need to pay. How does SARS go about doing an auto-assessment for you? Well, there's certain information that SARS will have already been sent from the likes of the banks, insurance institutions, etc. They then use this information to pre-populate your tax return, and based on that information calculate what tax refund may or may not be due to you, and or whether there is any tax or additional tax that you may need to pay. In terms of deductions that you may be eligible to claim, and that SARS would not know about and or may require you to complete on your tax return. These would include things such as a travel claim, if you've got any medical expenses that you wish to claim, and they may also include things such as a retirement annuity contribution. We're going to unpack each of these deductions in a little more detail so that you can understand the requirements from SARS and what you would need to put together in order to be able to claim these deductions. The first deduction we're going to talk about is the travel claim. So very simply, if you have a vehicle, a personal vehicle that you are using for business purposes and receive a travel allowance from your employer, SARS will allow you to claim business expenses against the income that you have earned during the year. In order to do this, SARS will require you to submit a logbook where you detail the trips that you've undertaken for the business, as well as providing certain details about the car that are then used to calculate the amount that is due to you. So what sort of information will you need to supply SARS with? Well, SARS will want to know at the start of the tax year what your opening mileage was, and then at the end of the tax year what your closing mileage is. You then need to supply SARS with the number of kilometers that you have travelled for business purposes, and then SARS will run a calculation in terms of what you are able to claim. Most importantly though, to support the business kilometers that you have travelled, SARS will require a logbook from you. In terms of the information that you have to supply in this logbook, you will need to give SARS the date of travel, where you left from, where you went to, and the reason that you undertook the trip, and then obviously supply them with the mileage. Other information SARS may request of you when you submit your travel claim is a copy of the purchase document so that they can verify the cost that you have told them the vehicle has, as well as any other details such as confirming that the vehicle is in your name. Another very common deduction that could be applicable to taxpayers is around medical expenses. There are two claims which you will be eligible for. One relates to your medical aid contributions, and then there is a second claim if you have additional medical expenses. In terms of contributions you make to the medical aid, SARS has a standard formula and fixed amount that it allows you as a claim for medical aid contributions based on the number of dependents on your medical aid. If you log onto our website and read our related blog, you'll be able to find out what these amounts are. In addition to the medical aid tax credits for the contributions you have made, SARS also gives you an additional claim for expenses that you have incurred and that are generally referred to as your out-of-pocket expenses. These cover medical costs that you may have paid or had to pay personally to doctors and or for dispensed medicine to you that you can then claim back from SARS. It's important to note that these expenses need to exceed 7.5% of your taxable income unless you are over the age of 65 and or you have a disabled family member. Otherwise, only the expenses that exceed the 7.5% will qualify for deduction, and then these expenses are not deducted in full. SARS divides these expenses by either a factor of 4 or 3. The 3 will apply if you have disabled family members and or are over 65 years of age. Another common deduction that taxpayers would have would be any contributions you've made to a retirement fund. So if you have a retirement annuity through a financial advisor, these contributions can be deducted from your tax return. There is a limit that SARS places on this, and that is that it's limited to 27.5% of your taxable income or 350,000 Rand, whatever is the higher. And another important point to note is that SARS adds any personal contributions you have made, such as the retirement annuity, to any contributions that your employer may have made if you are part of an employer pension or provident fund scheme. So if the contributions you've made personally, plus whatever has been made by your employer, happen to exceed 27.5% of your taxable income, you will not be able to claim all of the contributions on your current tax return. Another very common transaction that we come across and that we are asked to advise on is when people sell their house and whether there's any capital gains tax payable on the sale of their house. In terms of the selling of your home, SARS gives you an allowance of 2 million Rand, and it's called the primary residence rebate, on any gain that you may have made on the house. Very, very simply, what does it look like? SARS looks at the cost that you paid to buy the house, and then looks at what you received when you sold the house, and if the gain is more than 2 million Rand, you could be liable for capital gains tax on it. Just a couple of things to note. Any commission you pay or when you sell the house will be deducted from the proceeds used in that calculation. And then in terms of the cost to buy the house, it's not just what you paid for the house, but any transfer fees, transfer duty, bond registration costs, attorney's cost as part of that process, you will also be able to include in the cost of the house. Just a word of advice to everybody out there: if you have sold your primary residence, it does need to be declared on your tax return. SARS does have access to the deeds office. They will be aware that you have sold the property, and you need to disclose the fact that you've disposed of the house on your tax return. Okay, irrespective of whether there is any capital gains tax or not, the disposal and the sale of your property needs to be disclosed on your tax return. Whilst we're talking about properties, just something else to touch on is if you potentially have more than one property and are renting one out. Further to the point raised earlier, SARS does have access to the deeds office, and we are seeing an increase in cases where SARS is coming back and saying, please advise the taxpayer has a second residence. What is that residence being used for? Which is the taxpayer's primary residence? And if you are renting out the second property, make sure that you are disclosing that rental income on your tax return. In terms of the expenses, if you do happen to have an investment property that you can claim against it, obviously all income that you earn, so if you are recovering the electricity and the water, you need to declare that. You can then deduct those expenses, the water charges, the electricity rates, body corporate levies, any repairs and maintenance that you may have carried out on the property, as well as the interest on the bond for the property. Please just note, only the interest on the bond can be deducted. You cannot claim the full bond repayment. That includes a portion that you are paying back against the loan, and for tax purposes you cannot claim this as a deduction against the income that you're earning on the property. What are some other common items that you may need to include in your tax return or that you may be concerned about? A question we often receive is what happens if you sell a car or a boat? These are referred to as personal use assets, and SARS doesn't look at any capital gains tax or income tax on the sale of those assets. So I've mentioned two of them already: caravans, boats, cars, your household furniture. These are common items that you do not need to pay any tax on should you dispose of them during the year. Another item that we regularly see coming through on people's tax returns is interest that is earned. This could be on a bank savings account, or as part of an investment that you've made. There may be an interest component to that investment that your financial advisor has made for you. The rules around interest: if you earn more than 23,800 Rand worth of interest on a savings account or an investment or all of the above, the amount that exceeds the 23,800 Rand will be subject to tax from SARS. If you are older than 65 years of age, however, SARS increases this amount to 34,500 Rand. Thank you for listening to our video. We've just given you a couple of the more common items that tend to find their way on people's tax returns. Please feel free to reach out to us to assist you with your submission, or if you have any queries or would like advice on any other items that you want to know, should they or should they not be disclosed on your income tax return.